This video is for the beginner looking to invest a few bucks or have more control over his or her investments. These ideas, strategies, and subjects should serve as an excellent foundation for your stock market education. They aren't everything you need to know, and they don't guarantee success, but they're a terrific place to start for any investor. Watch this video to the end to head start your investing career. Hey guys, welcome back to the Ring of Knowledge, your trusted source of practical financial knowledge for a wealthy lifestyle. Many financial terms, or actually phenomena, are interconnected, and you actually need to know what effect one has on another to make good financial decisions. So, in today's episode, we're going to learn 10 things you must know about stocks. Before moving on, subscribe to the channel and smash that like button. Now, without wasting much time, let's get started. Number 10. Open your personal trading accounts. To begin investing in the stock market directly, you'll need a stock trading account. There are numerous brokerage houses from which to choose. Contacting your bank is one of the easiest steps you can do. The majority of banks offer brokerage and services. You may feel more at ease doing this because you are already familiar with your bank. Number 9. Begin small. Begin investing with a small sum of money. Because you'll be learning throughout your first few months in the stock market, it's best if you commit lesser quantities of money. Even if you have a huge sum of money to invest, take your time. You can increase your allocation once you have gained sufficient experience and are confident in your ability to invest successfully. Number 8. Never enter the stock market naively. The stock market is not a money-making machine. Many times, while talking to your friends and colleagues, the conversation heads in the direction of the stock market and also how someone can make huge amounts of money from the stock market. Even though you have never experienced the market, but after hearing about huge, you also decide to enter the market. However, if you invested in the market just to remain in mainstream fashion, you've landed for the wrong reason. You should always invest in the stock market after getting a basic knowledge about it and consider your financial goals. Number 7. Educate yourself and start with the basics. Take the time to grasp the fundamentals of the stock market and the different stocks that comprise it before making your initial investment. An old proverb goes, "It's not a stock market, but a market of stocks." In the beginning, your attention will be drawn to the specific stocks in which you are investing, as well as the relationship to the broader economy and the factors that affect the movement of your stock. Before joining the market, you should be conversant with the following topics: understanding financial measures and terminologies like PE, EPS, ROE, market cap, and so on, popular stock selection and timing methods like fundamental and technical analysis, trading fundamentals, regulations, compliances, and terminology such as market order types such as market orders, limit orders, stop loss orders, stop limit, trailing stop loss orders, and other types often used by investors, as well as margin money required if you wish to trade in F&O. Number 6. Invest just your excess funds and avoid using leverage. The most common mistake that new investors make is investing money that they cannot afford to lose. Investing in the stock market is dangerous, which means you may lose everything. The stock market, like any other investment, has inherent dangers. Some risks are systemic in nature and cannot be avoided by diversifying your portfolio, whereas others are stock-specific and can be avoided. You must determine your own risk tolerance based on your age, financial status, retirement goal, and other factors, and then decide whether or not to take the risk. If you wish to invest in the stock market, only invest funds that you can afford to lose. Investment is done to make more money, but do not put all of your emergency assets on the stock market. Leverage simply refers to the utilization of borrowed funds to carry out your stock market strategy. Banks and brokerage firms lend you money to buy stocks through a margin account. It sounds fantastic while the stock market's rising, but consider what happens when the stock market or your stock falls. In that situation, your loss would not just erode your initial investment, but you would also have to pay the broker's interest. Thus, leverage is a tool, neither good nor harmful. It is, however, best used when you have gained experience and trust in your decision-making abilities. Limit your risk when you first start out to ensure you can profit in the long run. Number 5. Don't try to time the market, and don't let your emotions dictate your investment. The bulk of investors attempt to time the market, something financial planners have constantly warned them against, and consequently lose their hard-earned money. No one can accurately and consistently time the market by identifying tops and bottoms throughout numerous business or stock market cycles. You can invest little amounts of money over time to average the market and benefit in the long run. Long-term investors investors who invest in the correct stocks consistently achieve exceptional returns. As a result, patience and a disciplined investment approach are advised, as well as keeping a long-term broad picture in mind. Keep your emotions separate from any particular stock, as many investors lose money in the stock market owing to their failure to control their emotions. Break the cycle of fear and greed. Don't buy any speculative, unknown stock enticed by its prior fantastic return unless you realize the risk involved, which will result in loss. In a bear market, don't panic and sell your stocks at rock-bottom prices. Thus, you should avoid fear and greed, as they are the worst emotions to have when investing. Number 4. Dividends are your friend. Think of the long term. Taxes aren't the only reason most investors avoid short-term trading. Trying to purchase or sell stocks based on a quarterly earnings report or a piece of economic data is a game for computerized trading platforms, not the ordinary Joe. Better possibilities arise when a stock or industry is ignored by the market and languishes despite a consistent economic performance that will generate a continuous stream of profits for a long time. Transportation equities, such as airlines and railroads, have long been out of favor, only to see significant returns when economic conditions and business dynamics match. Kevin O'Leary, a Shark Tank investor, is fond of a figure that demonstrates that the majority of the S&P 500's returns over the years have come from dividends rather than price appreciation. That is why he claims he will never own a stock that does not distribute at least some of its profits to shareholders. Number 3. Price to earnings. Consider for a moment that you're looking for someone to assist you with your investments. You meet with 2 financial counselors. One has a long history of making a lot of money for people, your friends have experienced a significant return from this financial advisor, and you see no reason why you shouldn't put your money in their hands. They tell you that they will keep 40 cents for every $1 they make for you, leaving you with 60 cents. The other financial advisor is still in the initial phase of his career. They have limited experience, and while they appear potentially good, they do not have a track record of accomplishment. The benefit of investing with this financial manager is that they are less expensive. They simply want to keep 20 cents out of every dollar you make. But what if they don't bring in as much money as the first financial advisor? The PE ratio is calculated by comparing the current market price to the total earnings over the previous 4 quarters. Compare this value to other companies similar to the one you're looking into. If your company's PE ratio is larger than that of other similar companies, there must be a cause. If it has a lower PE ratio but is rising quickly, it's an investment to keep an eye on. Number 2. Beta. Beta appears to be a difficult concept to grasp, but it's not. It gauges volatility, or how volatile the stock of your company has been during the last 5 years. In essence, it compares the systemic risk of a company's stock to that of the entire market. When studying stock research pages such as those accessible on Yahoo or Google, you can usually locate the beta value of the stock on the same section as the PE ratio. Consider the S&P 500 to be a pillar of mental stability. Your company has a larger beta if its value declines or grows more than the index during a 5-year period. What does beta indicate about price risk? What it says about fundamental risk factors. You must keep a tight eye on high beta stocks because while they have the capability to make you multi-fold returns, they also have the capacity to take your money. A smaller beta indicates that a stock does not react as strongly to changes in the S&P 500. This is considered as a defensive stock since your money is significantly safer. You won't make as much in as little time, but you also won't have to watch it every day. However, beta is a backward-looking indicator. It only measures systematic risk and doesn't include risks such as companies having too much debt, losing a big lawsuit, or slowing consumer demand. Number 1. The diagram. There are numerous sorts of stock charts. Line charts, bar charts, and candlestick charts are examples of charts used by both fundamental and technical analysts. However, reading these charts is not always simple. In fact, it can be really difficult. Reading them is a skill that takes a long time to master. So, as a retail investor, what does this mean for you? You do not have to skip this step. This is due to the fact that basic chart reading requires very little talent. It's a favorable sign if an investment's chart begins in the lower left and ends in the upper right. If the chart is trending downward, stay away and don't try to comprehend why. There are tons of stocks to choose from that do not lose money. If you truly believe in this stock, add it to your watch list and return to it later. Many people believe in investing in stocks with frightening looking charts, but they have research time and resources that you don't. That's it for the video, guys. Hope this video provided great info. Press that like button if it did. Comment down which tip you would apply to your investments. Share the content to spread the good info. Subscribe to Ring of Knowledge for more amazing and helpful finance content that will put you ahead of the world. Peace out.